We're now about to begin our second panel on discretionary trading, moderated by Pablo Calderini, our President and CIO. We'll focus on a number of subjects ranging from idea generation to managing risk successfully. As I discussed earlier, I think the opportunity set for macro over the next several years is going to be really exciting. I think our portfolio managers are going to tell you better than I can why that is and how they feel this is a unique moment in time for what they do. As I look back over the last decade, as I said earlier, it was absolutely phenomenal for beta. As I look ahead, I'm not so sure how constructive it is for traditional investments. I think about this moment in time as an equity investor, as a fixed income investor, and it's intimidating to me. As I look ahead for what we do, with the volatility that I expect in foreign exchange trading, in fixed income trading, in the equity markets, in the commodity markets, all of the issues that affect what we do that are going on in the world, it's extremely exciting to be in the seat that we're in of running a macro fund. And with that in mind, I think you'll find hearing directly from our traders about how they do what they do, how they manage risk, and how they look for opportunities to be very, very insightful. From what Pablo and I do as managing our discretionary business, we focus on risk management, cultivating talent, mentoring our portfolio managers, enabling them to be the best that they can possibly be. We've also strategically focused on diversifying the types of traders we have at Graham, including traders that are not so macro focused and fit in our plans for our multi-strat fund that is somewhat less macro focused than our flagship absolute return fund. Our resources to pursue new sources of alpha are very important to Graham and are part of our longstanding commitment to never stand still, but always to be looking forward as how we can improve and expand the different sources of alpha that we enjoy at Graham and our clients can participate in.
Hi and welcome to our discretionary panel. With everybody talking about macro, we are hoping we are going to have a great discussion today. I am Pablo Calderini. I'm the CIO and President of Graham Capital. And here on the panel, we have our Chief Economist, Kelly Tropping-Whitridge. We have two of the longest tenure and most senior portfolio managers at Graham, Peter Jepsen and David Keelan. And we have our Chief Risk Officer, Chris McCann. So with that, and starting with Kelly. Kelly, your role is research focused, and you work closely with the PMs on the economic outlook and the direction of monetary policy. Clearly, this has been a huge year for central banks, and in particular, a context that has been super different to the pre-pandemic when central banks were super inactive, right? So in that context, can you talk to us about how the current opportunity set, and in particular, can you compare that to the pre-pandemic setting?
Sure. So thanks, Pablo. When we look back to the pre-pandemic period for central banks, at that point in time, using the Fed as an example, the policy priority was really bringing inflation that had been too low for the past decade back up to target. And that very low inflation backdrop had allowed the Fed to be quick to ease and slow to tighten. And we saw this in the Fed tightening cycle in 2015 through 18, when the Fed was only tightening every other meeting and only at a 25 basis point pace. And this also allowed the Fed to really accommodate any downside risk to growth because they really weren't concerned about the inflationary consequences of easy monetary policy. And this was commonly referred to as the Fed put. With that backdrop, as we moved into the pandemic period, the Fed really wasn't concerned about aggressively easing policy as the economy entered a very deep recession in the pandemic. And also as they came out of the pandemic period and we started to see the first few very high inflation prints, the Fed was very confident at that time calling high inflation transitory because for so long, inflation had been so low. And actually, if anything, the Fed was welcoming these early high inflation prints. If we look back to the August 2020 Jackson Hole conference, at that point in time, the Fed had introduced a new framework called flexible average inflation targeting that was actually oriented around bringing inflation back up to target and re-anchoring inflation expectations to the upside at 2%. So all of this had made the Fed really slow to respond to inflation developments, and in the pre-pandemic period had made them really kind of slow to ease, quick to ease, slow to tighten, and kind of made that Fed put a feature of monetary policy and allowed them to introduce extraordinary policies such as forward guidance, where they said what they were going to do. Their moves were extremely well telegraphed. They could conduct policies like QE without much fear of the inflationary consequences. Now, of course, the Fed has been proven wrong in that assumption, with inflation proving to be so much more persistent and so much more broad-based than they had expected. They really could not have imagined inflation kind of exploding like it has and remaining there for so long. So when I think back to the beginning of this year and the end of last year, one of the things that I think was so different for central bank watching is we could come into the year and have a strong view about where inflation was going, where the labor market was going, and see that the Fed was really wrongly positioned for this environment. And in a way, it allowed us to have more of an edge in figuring out what the Fed was likely to do. For so long, the policy had been so well telegraphed, so well understood. The Fed wasn't willing, they didn't need to do too much in the pre-pandemic period. And so that gave us a real opportunity to think about kind of outside the box about what monetary policy would have to do. And then those dynamics played out across many different central banks, where they started to surprise with just how aggressive they would be. So that's sort of how the broad backdrop has shifted for central banks and created a lot of interesting opportunities for us in thinking about central bank policy. And the outlook continues to be really interesting. We just to give some perspective, we're speaking in September. About a year ago, the Fed was still doing QE, and the question was, when would they taper? Now the policy debate is about how many 75 basis point increases the Fed will do, how quickly will they keep tightening, and we're seeing that across many central banks, where it's about how fast and how high policy rates will have to go.
Thank you. And while you and your team do the heavy lifting in terms of research, you also work very closely with PMs, because they are closer to markets, right? So it's a process where you do the research and feed to the PMs, but then you also learn from them what markets are thinking and pricing, which is quite critical. Can you please talk to us about how do you work with the PMs?
Sure. So, my team doesn't have a house view that PMs have to put on, but there are times when, we do see really unique opportunities where what we're thinking about the Fed is really outside of what the consensus is thinking. And I look back to actually the end of last year in 2021, we had picked up on some hints in the December press conference from the Fed that they might, for example, be considering running off their balance sheet much earlier than people had been expecting. And this was a time when the Fed was actually still conducting QE. So it seemed like a pretty surprising development if it were to come to pass. And also there was questions over when the first rate hike would come. So that was a perfect example of where we saw a significant opportunity, where there weren't things people were talking about very much in the markets. And so I vividly remember coming into the year, publishing some pieces and speaking directly with our PMs and saying, we think this is really interesting. It's a little bit outside the consensus. Of course, we're always kind of cautious and not hammering home any view, but when we think that there's something that would be a really unique opportunity to take advantage of, we certainly want to communicate that to the PMs with sort of this broader mission of making sure our PMs are kind of extremely well prepared for any central bank event that might come to pass, even as they ultimately express it in their own way, and they don't have to agree with us. At a minimum, we've provided all the information and given them sort of the best position going into any central bank event.
Thanks, Kelly. Now, David, Peter, you are PMs with massive track records, many, many decades of trading macro markets, most of those years at Graham. And both of you have said to me that you see this as a generational moment for macro. Can you elaborate on that? Maybe we start with you, Peter.
Yeah, sure. I mean, first of all, this inflation, we've never seen inflation like this. And I think anyone working right now, unless they're been working a really long time, has never seen inflation like this. And when I got into business in the mid-90s, I used to say inflation was the hardest variable to predict. And people forgot that over the last 20 years, and you get 0.2, 0.2, 0.2 every month. And so that leads to a lot of problems in terms of everybody's models, in terms of central bank response. Central bank response is now, in fact, policy response in general, it's like back to the future. So you have global central banks that hike in response to a high headline CPI, or even, the Fed hiked extra in response to a higher than expected University of Michigan inflation expectation survey. And then you have governments that, what are they doing? They're actually spending more money to help people afford higher prices. So it's kind of like a back to the future moment. And so we haven't seen that in our careers. And what does that also mean? The 60-40 portfolio, the death of that, the negative correlation between stocks and bonds that allowed people to construct such positive expected value portfolios, that's gone. There's some secular changes too, right? Maybe a reversal of the globalization that we've seen for most of our careers. I think a reversal of the capital versus labor dynamics, where labor has developed more power again. And I think finally, what that means is that everyone's kind of on equal footing. The economists don't know any more than we do. I think it puts a real premium on just using common sense, using your own eyes, and just it puts everyone more on equal footing. So it puts a real premium on maybe proper risk management. And Kelly mentioned thinking outside the box. I think it puts a premium on using your imagination, because things are different now. We haven't had this, since I started my career. Doesn't mean it's easy, but it just means you get a lot of at-bats.
So. And David, your thoughts on that?
Yeah, I would echo a lot of what Peter and Kelly highlighted. I mean, you think about coming in to the financial world in the early 90s. The stage was set with rates where they were, and stocks at reasonable valuations, and we were just getting into this unbelievable technological boom. So it set up risk parity for decades, and then we went to such a level because of the pandemic and the fiscal monetary response globally that, you had $7 trillion of negative yielding debt, which I still don't quite wrap my head around, but it was there. And then if you looked at stock valuations, they were at, kind of all-time high. So risk parity went to such an extreme that it's gotten thrown out the window. Since the financial crisis, essentially, I mean, the degree of central bank involvement in the financial markets has just been kind of mind-boggling. I mean, the Fed did step away for a while, and actually they were trying to shrink their balance sheet. But if you look, what Europe was doing, and even around the globe, it served to tamp volatility. I mean, QE brings down vol, and it allows people to kind of go, the central banks want you to go further out in the risk spectrum. So you get 3% mortgages, you get credit where companies can borrow at like these crazy economic levels. And so now this is a whole new playbook that we really haven't seen in our career. So, you listen to the financial presses, everyone's trying to figure out when the bottom is in, and, buy the dip, perhaps the Fed is pivoting. And it's just, that's the old playbook. The Fed put, there is a Fed put, but it's struck so far down that we're not quite sure where that is yet. And we have to get, these guys, are going to do what it takes to get inflation line, and their credibility is on the line. So I think it's just, this is a different environment, and it's going to take a little while to play out, but it creates a lot more volatility and a lot more opportunity with the volatility.
Yeah, absolutely. Clearly this is a huge change in paradigm, and some great trades have come out of these patterns. Can you elaborate, both of you? Maybe we start with you, Dave.
Yeah, it's obviously this year, long the dollar, short rates, short equities has been the trade to be in, but this is kind of the classic bear market too, though, where the adage is no one makes money in the bear market because the bear market rallies are so vicious. And we did see a summer rally where stocks had a 20% bounce off the lows, and at the same time, 10-year notes rallied, I think, 75 basis points. So we went from this anti-risk parity world to all of a sudden risk parity was back. And what caused it? Just sentiment. So you have to be, and then again, this is the opportunity set. If you are aware when the market gets super oversold, where the sentiment is so dire that the market could snap back, that creates the opportunity. I don't know, Pete, anything to add in?
Going forward?
Trades this year that have worked for you?
Trades that you've seen this year that have.
Yeah, well, kind of like you said, the classics have been like short risk parity, which meaning short stocks and short bonds. Dollar's been very strong, but there's also been a lot of movement within dollars, like yen moved a lot. Stuff like Mexican peso, even with tremendous carries, appreciated as you had, like, I guess they call it kind of reshoring type stuff from, out of the East back to North America. And there's been a lot of micro stuff too. There's just a lot of stories. I think the broader story is what you said, though, is the risk parity in the dollar. And that's probably where most of the returns have come from in one form or another.
Thank you. So, well, clearly macro is a very interesting style, but at times we have low conviction that leads to low positions. And then there are other times, like I would say this year, where we have very strong conviction that leads to much more risk taking. And I would say that that's really one of the hallmarks of macro trading, this idea of matching conviction to positions and trading dynamically. And that's really one of the ways in which we can create value. At the same time, it can create a challenge for risk management. So I want to ask Chris, as our Chief Risk Officer, how do you think about that and how do you deal with that?
All right. So Pablo, I think you're getting at one of the key differentiators of macro investing and, sort of helping me explain here why this has been a favorable environment for what Peter and Dave are doing. So generally, we're structuring our portfolios to have relatively high diversification. From the time we're interviewing PMs, we're talking about what can they add that's different to the portfolio. When we're doing asset allocation every month, we're trying to make sure that we're taking pairwise correlation into account so that we're not putting all of our assets into one style of investing. And generally, that's the way that you'd like to be. But when we get into some environments, what you'll find is that the investment themes become stronger. And even, our entire list of PMs, all looking at things in their own independent way, trading their own styles, trading their own securities, lead sort of to the same path, sort of the same conclusion. And then you can end up with periods like what we've seen this year, where the trade themes, frankly, were just a little bit clearer. So then you end up with this higher correlation. And what we've found is in times of the higher correlation, we actually have a higher information ratio among our PMs. However, they also tend to be times of higher volatility. So there's a little bit of a natural offset in terms of position sizing. When volatility is higher, portfolio managers will take smaller positions. And what you find is the offset in terms of looking at different risk statistics. When we're well diversified, at the money measures like VAR tend to be relatively low, but tail risks tend to be higher because people have higher position sizes to offset the fact that volatility is low. On the other hand, this year, what we're seeing is relatively high at the money stats. So VAR is running much higher than it had historically. Our realized volatility is running a little bit higher over the past month or so. But we're finding that the tail risks are a lot smaller because the position sizes are smaller. So although it presents some challenges, looking at a statistic like VAR, Dave and Peter both talked about unstable correlations. So that makes sort of the value of a statistic like VAR a little bit less valuable. It makes statistics like stress tests more valuable, though, because really that's what we're concerned about in markets like this, where gap risk is really what you need to be concerned about. So, putting all things together, it's just a different environment. I wouldn't say that the higher volatility is necessarily more challenging. There are different things that offset that higher volatility. And if nothing else, this is just a far more interesting environment in which, for these guys to be operating.
Right. Thanks, Chris. So let's move now to outlook. We have 1 quarter left, and then we have 2023 that arguably is a massive year. Are we going to go into depression? Are we going to go into soft landing? So many different scenarios that we will be able to take opportunity and be able to trade upon the different outlooks, right? But let's start with Kelly and the outlook for monetary policy. What are you expecting from central banks?
Sure. So we operate from the starting perspective. Peter mentioned some of these dynamics that have been driving inflation higher. We don't think that those are going to resolve anytime soon. We think inflation will remain persistently high. We've seen a lot of persistence in the services sector, and some of those sectors that should have been starting to cool in the post-pandemic period in core goods, those are remaining really sticky and high. So if we start with the baseline view that we think inflation is going to remain entrenched, we think that that means that the Fed has a lot more work to do if we start with that central bank. So we think as we look ahead to next year, perhaps the surprise will be in just how high the terminal rate will be. Back to this sort of idea of having to think creatively and think, outside the box. At first it seemed unimaginable that the Fed would have to be really restrictive. Then we started talking about whether the terminal rate could be in the 4% range. Next year, we started asking the question of whether the funds rate will be in the 5% range. So we think that there's a lot of interesting work left to do on the Fed side. And importantly, if you start with that baseline view that inflation is going to remain entrenched, that means that the odds of a soft landing that the Fed has been hoping for are a lot lower. And unfortunately, we've started to see the Fed also start to acknowledge that as they've articulated their resolve in tackling the inflation problem. But also outside of the Fed, there's a lot of interesting opportunities, particularly when you think about the European central banks. Those banks have a really interesting problem. They have much more risk from higher energy prices that will just make inflation even higher and also create more risks of second round effects to inflation expectations, for example. But that will also weigh very heavily on their economy. So we're seeing those central banks having to tighten into recessions, which is something, again, going back to this idea of central banks previously being able to accommodate downside risks to growth. Now it's the opposite as we look ahead to 2023. So those are some of the opportunities we're focused on, thinking about just how high terminal rates will have to go and what obviously the ripple effects are across global markets. But then I'd also point out there could be interesting surprises on the other side if we're all wrong about inflation and it sort of magically cools. Of course, there will be really interesting opportunities as perhaps central banks move to easing cycles. So that's not our baseline expectation, but the point is we've got a lot of questions about the economic outlook, real questions. As Peter mentioned, we haven't seen these dynamics play out for a very long time, and that makes it really exciting and a lot of opportunities to kind of think really carefully and seriously about what could happen with monetary policy and these economic outlooks in 2023.
I agree. And from a PM standpoint, what are great trade ideas that you're either working on or you think can emerge in this context? Let's start with Peter.
Oh, well, I think the inflation thing is so important, and the fact that a lot of economists think that it's just going to magically go down to 2, which is kind of an artificial level. I mean, when the global central banks pick 2% as a level, it's kind of, there's no reason for it really. And so I think it's kind of weird to think inflation is going to go up to 8 and then just come down to 2 and everything's going to be cool. So I think there's going to be continued volatility. I agree with Kelly. I think inflation is going to continue to stay high. Or, I mean, it's not my base case, but maybe we go to deflation. But the fact it's going to 2 is ludicrous. So for me, I think liquidity is going to keep tightening globally. I think it's bad for risk assets. I was out with a good friend of mine last night, and she's turned 60 and she's retiring, and she's like, "What do I do with my retirement nest egg?" And I was like, "I don't know. I think you're kind of in trouble, actually." So I think that's bad for traditional investors, and I think that's good for us. my outlook would be, I think risk assets continue to sell off. I think stocks and bonds sell off. Dollar could be a little trickier, but I think there's a lot of stories within that. Japan, it's kind of, I think, defies the imagination that Japan's going to be the only developed country on earth that doesn't have inflation. But you know, that's where a lot of the opportunities are. People are so stuck in the old ways that they don't have any imagination whatsoever. So I think those are some of the things. But there's a million stories every day, and that's what makes this. It's hard, but it makes it a little more fun.
Thank you, Peter.
Yeah.
What are you thinking, Dave?
Yeah, I echo some of Peter's thoughts, but I mean, Japan, for instance, they just put up 30-year high inflation last night. You know, it's 3%. It's not crazy relative to the rest of the world, but you know, why are they doing yield curve control? And you can see the market's trying to test them a little bit. And then obviously their currency's just gotten just wailed on this year. And at what point can they really step in and intervene in the currency if they're you know, buying all the treasuries or all the JGBs that you know, the company they're issuing? So it's just, I think that's going to be very curious to see how that plays out. Grota's term is up next year as well, and with the new leadership, do they change things? You know, the big variable in Europe is the winter. I mean, if it's a cold winter, you know, Europe's in a lot of trouble, and you know, we'll have to see how that plays out. You know, China, a huge part of the global equation, like what's going to happen with their zero COVID policy after she's named premier again for, I guess, in October. So, I mean, there's a lot of variables that we just have to see how they play out. But, you know, I think there's just some core things that again, these guys have touched on. You know, inflation's sticky. The central bank's going probably a little farther than the market thinks. And then in this background too, there's this quantitative tightening going on that we really haven't seen before. And do real yields keep going because we're shrinking our balance sheet larger than we really ever have? And then that leads to all sorts of questions. At what point do yields maybe get too high where central banks, you know, might flinch? So I think it's going to be like tremendous opportunity set continuing, but it's just there's some known unknowns. We have to see how it plays out.
Yeah, that's actually a really good point. I mean, we are clearly seeing lots of opportunities, but we're also seeing huge uncertainty. We have very high volatilities. We have record cross-asset correlations. We have low liquidity. So in that context, Chris, how do you factor, you and your team, how do you work around that, and how do you factor those issues?
Sure. So risk management at Graham is a lot bigger than just my team. You know, first of all, I mean, frontline risk management is done by experienced portfolio managers like Peter and Dave, right? You know, they've survived in the markets for a long period of time because they know how to size their positions for the long run. And then my team, you know, mostly what we are doing is advising the risk committee. The risk committee has existed at Graham since the early days of the global financial crisis. They've met every single day since then. So if you think about that, that's about 4,000 risk committee meetings that have taken place over the years. And that's a long history of monitoring. Now, what my team is providing to the risk committee is sort of two separate things. We're quantitative analysis of the risks that the portfolio managers are taking, and then a qualitative analysis of the risks that they're intending to have. From the quantitative standpoint, we're running all of the standard risk statistics that you'd expect every day. We're running Greeks on, you know, all of the positions in the book. We're aggregating them into different portfolios, different strategies, different investor funds. We're running hundreds of shocks, dozens of stress tests. We're running VAR exposures, all the things that you'd expect to see. And that sort of tells me the what of the position, but it doesn't tell me the why. We get the why of the position, the qualitative aspect of the position, from sitting right there on the trading floor. You know, the risk management at Graham, we're not sitting off on the sideline just waiting to be police and come out and tell PMs when they're over a risk limit. We want to know what they're doing. We want to understand what they're doing. I need to be able to represent every day to Ken or to Pablo or to Brian, you know, what our PMs are intending to have as far as risks in the market, because the risk committee is made up of managers that are not actively managing risk. We're sort of a cold eyes review on the process. So we've got our own way of looking at things that don't have any biases as far as positions go. We're just taking what the portfolio managers are saying and comparing that to what we're hearing is going on in the world out there. So I think this is a good process for managing risk, monitoring risk. I don't say controlling risk necessarily. The portfolio managers are controlling the risk, and we're just advising them as to whether or not the investor funds have more risk than the target volatilities that we had intended. And in which case, we'll work on that. We'll figure out what to do about that, where we can mitigate some of the excess risk. But for the most part, risk management and the risk committee are there as monitoring.
Thank you. So yes, from a PM standpoint, how do you, David, then Peter, how do you think about this high risk and how do you factor them in when you're building your portfolios?
So the way I think about it, it's actually, from my standpoint, it's actually not that much different than any other time. You size, to state the obvious, you size your positions in vol units. So, and Chris said this earlier, and higher, if vol's higher, your notional size is smaller. I guess that's obvious. Then you have to be ready for tails and gap risk, and you also put a premium now, I think, on more liquid things because liquidity in the markets are terrible, and so some trades you just might not take because it's just too liquid. You can't get a big enough position to make a dent. As far as how it all goes together, though, for me, it's no different. I was trained in volatile environments, and so the more volatile and the more stories, it's better. And so the way I think about putting it all together is, for me, it's bottom up. So I try to find ideas. And once the ideas come together, then I look at my overall risk and make sure it's oriented to the way we want it. And then finally, I'm looking at the other risk I'm looking at is, because Dave mentioned it earlier, how everything's overbought. I mean, stocks get oversold, things like that. There is a factor that's what I call a sentiment factor. So sometimes things get correlated. Everything that's overbought gets sold, and everything that's oversold gets bought, and we're always cognizant of that as well. And so for me, that's kind of how I look at the risk overall, and that's kind of how I do it, whether it's 2018 and kind of quiet, or 2022 and really busy.
Yeah, I mean, I think I'm similar as well. It's getting the themes right. This is the key. So if you catch the themes, then structuring the portfolio is much easier. I mean, when you're on the wrong side of trades, it really doesn't matter how well structured you are. So, but what we focused a lot on, well, sizing obviously, and sizing is so critical because you want to have it right. So if you're right, it works, you feel it, it's at the portfolio level, but you don't want to be too big that if there's some noise, you get shaken out. So, we've done a lot of work and improvements on the sizing of our positions over the years, and have improved a little bit on that. And then, we're trading multiple asset classes, and then one of these cross correlations can get super tight. So you could be in the dollar rates and equities, but it's all the same trade. So to really, really be aware of these cross correlations and understanding just how so for instance, going into a central bank meeting, these things will all be one trade. So the idea of shrinking the book, so you are still making a big bet, but you're not making a triple size bet on an outcome of a meeting, has been super important. And then, especially in volatile markets, there's investing and trading, and you can do both. So you have your themes, you have your core views, you have your core investments, but then you can trade around. The market can retrace. You can try to get a little bigger. You can press. We can get short squeezes. You can fade it. You can take profits at key levels, things like that. So it just creates a lot more opportunities. A lot more movement in the market. The liquidity is definitely a factor, so you just have to be very respectful of that. But it's the art and the science of it, I guess, Pablo.
And the sizing is so important.
Yeah.
Like we have. I mean, Chris mentioned risk starts with the PMs, and we have our own team risk meeting every day in the afternoon. one of the questions everyone has to answer, literally everyone has to answer is, what positions are too big and what positions are too small? And you get that right, and that's really important.
100%.
Yeah. Pablo, can I follow up on that just a little bit?
Absolutely.
So, and I think Dave also made the distinction there sort of between investing and trading. And I think this is another differentiator of the way we're looking at risk and sort of the macro investing in general is the fact that, I can see coming into an event that all of the portfolio managers are going through this exercise. And, we don't necessarily have an edge going into any given event, certainly not into every event. So portfolio managers, especially this year, where there are a lot of opportunities to react, have been tending to scale down into events and then reacting to what happens. And there tend to still be opportunities afterwards. Whereas if you're running a long only book or some sort of strategy like that, or something that is less liquid than what our portfolio managers are doing, you don't have the ability to be scaling up and down when there are events nearly every day on the calendar.
That's a very good point. Good. Well, so this has been a great discussion. I want to thank the panelists, and maybe at the high level, I would say that the key takeaways are, to begin with, inflation is really a game changer. For the last 10 years or so, the pre-pandemic decade, every shock was met by looser and looser monetary policy, whether that was quantitative easing or lower rates. And that created a very, very stable environment, an environment that some people call suppressed volatility. David referred here to the Fed put. And inflation changes that because now we have a macroeconomic shock that has to be met by another macroeconomic shock, which is much more tighter monetary policy. And that creates a huge instability, massive volatility, and tremendous opportunity for what we do. So that is the first one, and it's a big change in paradigm. And the second one, and maybe the key takeaway, is that while we look at the current period and we feel that it's extremely volatile and feels incredibly volatile vis-a-vis, again, the pre-pandemic decade, when we look at the world pre-2010, the markets were volatile for many, many decades. That was the norm. That was what was normal for markets. So I think it's time that we start seeing the 2010-20 period as an anomaly, a period that will very unlikely come back. And in that context, I think we have to brace for much higher volatility, for markets that are going to be behaving closely, not exactly, but very closely to how they are behaving now. And again, how they behaved for 40, 50 years pre-2010. So with that, I want to conclude, thank everybody, and then encourage you to submit questions if you have so. Thank you.